Hello guys, welcome to Core Academy, and in this video we'll be talking about a very important concept in finance, and that is what is a stock split. Simply put, a stock split is when a company divides the existing shares of its stock into multiple new shares to boost the stock's liquidity. For example, let's suppose that after the initial public offering or IPO, the stock of the company, that is one share of the company, was trading at $10. Over the years, the company did very well, and after 2 years, the price of the share of the company went up to $500. Now, for investors like Warren Buffett, see, it doesn't matter. They can buy as many shares of company X, even if they are at $500. But for a small investor, for example, a finance student, if he wanted to buy a share of that particular company, it would be very difficult because only one share costs $500. So in that case, the liquidity of the shares decreases a lot. So companies do stock splits. That is, they divide their existing shares to to decrease the value of the stock to decrease the value of the stock. So most common stock split ratios are 2-for-1, 3-for-1, which means that the stockholder will have 2 or 3 shares respectively for every share held earlier. So if there is a 3-for-1 stock split and an investor had one share previously of $10, now he will have 3 shares, but each share will be worth $3.33. That is, total dollar value of his shareholding will remain the same because no value is being added, only number of shares are increased. So Amazon, for example, had 3 stock splits in history because Amazon did very well over the years and their share prices increased dramatically. But even then, after 3 stock splits on 27th of April 2020, one share of its stock was worth $3,417. So you can see how the share prices of the profitable companies increase, and that would of course make it very difficult for a small investor to invest in Amazon and purchase many shares. For example, even buying 10 shares is very difficult because that would cost $3,400. So Amazon might or might not indulge in another stock split. Well, that depends upon the management. But this shows you how important these stock splits are and why they are done. Remember, although the number of shares outstanding increases by a specific multiple, the total dollar value of the shares remains the same compared to the pre-split amounts because the split does not add any real value, just as we discussed in the previous slide. So I hope this helped you a lot. And if you want to watch other videos on very important concepts in finance, accounting, management, do explore the playlist. And yes, don't forget to subscribe the channel. Thank you.